Hello everybody, welcome once again. I am Krishna and I am your mentor and teacher. Today we are meeting here for class 12 student, and today is the special day because we are going to start a new chapter today. Yes, in the previous couple of classes we had completed the chapter issue of debenture. Today which chapter we are going to start? Actually I was under quite a dilemma for this. I was unable to decide that whether I should start the chapter of ratio analysis or issue of share. Then finally I came to this decision, since we have completed issue of debenture chapter, I should take up upon the issue of shares chapter, because these both chapters are quite related to each other. Though in my live classes first I take issue of shares and then after that I always teach issue of debenture chapter, but here we are going in the reverse manner. But worry not, I am going to teach you all the concept in quite detail over here. Yes, many teachers don't even teach this concept in their regular batches and live classes, but I am going to teach over here everything in quite a detail, and that too free of cost. Yes, you have to just pay one thing over here, that is your time, and if you are paying your time over here, you will definitely become the master of this particular topic. I can vouch for it. So issue of share is a new chapter which we are starting here. Are you all excited for it? I am very excited, and I am assuming that you all are excited too. Let's get started then. So let's start this chapter issue of share, students. This chapter is very interesting, and let me tell you, interesting and important both. It's a very good combination. So for ISC board, this chapter alone stands for 11 marks. Yes, you heard me right. This is for 11 marks, and CBSE has not given a separate marking for this, but altogether it is 24 marks, which is issue company accounts. Company account includes of issue of shares, issue of debenture also, and final accounts some part of it, though final accounts is in the analysis of financial statement. So issue of shares and issue of debenture together we can say 24 marks for CBSE, and for ISC 11 marks. So this chapter is one of the most important chapter. So I want all of you to write along with me and pay full attention. The things which I am going to teach over here right now is the basic concepts of this chapter. What are the basic concepts? First of all, understand what is the meaning of shares. So shares ka type, if we talk about types of shares, are going to be of two types. Number one is preference shares and number two is equity share. You all must have studied in other theoretical subjects also, like business studies and commerce, that what is the meaning of preference share. Preference shares are the shares which have got preferential right over the equity shares. Preferential right at two places. Number one, while distributing the dividend, the company will pay dividend to first equity preference shareholder, and then only it will go to equity shares. So this is your preference share. Where do we write this? What is shares? Okay, where we have reached to the type first of all. So let us understand, go back a little and let us understand what are the shares. So all of us have done this final accounts of company, and in the final account of company, in the upper panel of the balance sheet, we write equity and liability. And under equity, we write shareholders fund, then share capital and reserves and surplus. So that share capital which we are writing over here, it is consisting of this equity share and preference share. So shares means part in the ownership. Company is the biggest form of the organization, so they issue the shares to the common public. I'm talking about the public company, and they collect money from them. So when they collect money from them, in return what do they give to the public is equity share or preference share. So their part in the ownership is called share capital. So this share capital is of two type, preference share and equity share. I said preferential right at two places. What are these two places? Number one, when company will issue the dividend to the shareholder, first preference shareholders will be paid the dividend, and then equity shareholders will be paid the dividend. Then second preference is at the time of liquidation of company or winding up of the company. So when company goes into the winding up or liquidation, so first after paying the outsiders liability, first preference shareholders will be paid their liability, means the capital will be returned back to them, and then equity shareholders number is going to come. So you must be thinking we should not buy equity share. Don't make that mistake. Equity share have the most powerful thing is the voting right. Yes, and the equity shareholders are the one who decide the major important thing in the company. So equity shareholders have the power of voting rights. Now, once we have understood that what are the type of shares, preference share or equity share, let's see how company can issue the shares, at what amount shares can be issued. Question, at what amount company can issue the shares, is actually we had dealt it in along with debenture also. Here also understand that this shares can be issued at par and at discount. Though in case of debentures we had seen at discount also, issue of shares is at discount is not possible. Who stops? Companies Act 2013 prohibits any company to issue the shares at discount. So only two cases will be there, issue of shares at premium and at discount. So understand that at par means what? At par means face value is going to be equal to the issue price. Now don't worry at all, I'm explaining you in a while what is the meaning of face value and issue price both. So face value is the value of shares on which the company is going to record the share capital in their books, or if you think about the share certificate, the physical certificate, which is not there nowadays, it's optional thing. So people normally have in the dematerialized form, but if they have the share certificate on which the value of share is printed, what is the value of share printed is called face value. So when the share, suppose the share is of rupees 10 and it is issued to the public at rupees 10 only, then it is called issue of shares at par. This situation is known as issue of share at par. The second situation is known as at premium. What is the meaning of premium? Issue of shares at the higher price than the face value. So here the face value is going to be lesser, the face value is going to be lesser and the issue price is going to be high. Issue price is going to be high means what? It is, let's say the share is of rupees 10 and it is issued to public for rupees 15. This is called issue of shares at premium. Now the immediate question which is coming in your mind, that why public will buy at a higher price? Maybe the company is such a good company, it is under Nifty 50, means the top most 50 performance companies it is coming in. It is a very old and well established company giving good returns to the public. Because of all these reasons, public will buy even at the higher prices because they know they are going to get the good returns. Okay, so we have understood what is issue of shares, preference shares and equity shares. Then we have seen what is issue of shares at premium and at par. Now, how the collection of amount will be done? How collection of amount will be done? Collection of amount means will be done. How it will be collected means company can collect the entire amount at one go, which is called at lump sum. And company can do it in installments also. Means if a share is, let's say, of rupees 100, this is the face value. Face value is rupees 100. The entire 100 rupees will be collected here. This is called issue of shares in lump sum. Means collection of entire money will be done along with the application, but it can be under installments also. So when it is done in installments means, let's say on application you receive 20 rupees, on allotment you are asking public to pay 40 rupees, on first call you are going to ask 20 rupees, on final call you are going to ask another 20 rupees. So like this, in parts, different parts, when the company is collecting money from public, you see that it's an issue of shares in installment. The similar kind of concept we had seen in issue of debenture also. Though in practicality, in reality, we will see this practice is done mostly by the companies. They take the entire amount in one go, but our 99% questions are going to be like this, where we will be collecting the amount in installment, because we have to understand the accounting part of it. That is why it is like this, that 99% of the question will have installment collection. Okay, so we will be understanding that. Now one more concept we will understand over here is subscription. What is subscription? Subscription money or subscribed capital. I had taught you when I was teaching you final accounts of company, the balance sheet of company, subscribed capital. So those who have not seen those videos, for them I'm just explaining, and please do watch. The link for final accounts of company will be given in the description box. So subscribed capital means the company, the public purchased that much of capital. Subscription, you can relate it to the Netflix subscription or Amazon Prime subscription, something like that. So people bought, how much people bought. So let's say suppose company has the two type of subscription, under subscription and over subscription. Let me explain you the over subscription. Over subscription is what? It is a situation where, let's say, company has called public that 10,000 shares we are issuing. So they're telling public, please come and buy 10,000 number of shares from us. Public is overwhelmed and there are 15,000 applications came. This is issued capital and this is applied capital. Okay, so 15,000 shareholders, the 15,000 applicants, not the shareholder, have applied for these 10,000 shares. Now, you as a student must be thinking, it's a very good situation. Issue 15,000 and collect all the money. Wrong. 2013, Companies Act 2013 stops or prohibit company from doing this. Why? Because they say if you're asking public for money, what is the shares? Issue of share is collection of money from the public. So you must have calculated this amount beforehand by the experts. It must have been calculated that okay, this much money is required, and whenever we ask people, we add into that for any kind of contingencies happening, emergencies happening, and changes in the business environment happening. Well calculated amount you're asking from the public. So if they are applying more, don't go for this option of taking more money from the public. But when that will happen, if you do that, more subscription has come and you're taking all that money from public and issuing them share, you are actually over capitalized. Over capitalized means you have taken the capital unnecessarily from the public, which was not required. And capital has a cost. You have to pay the dividend. And secondly, one more threat of this is that the directors will use the money recklessly, which is public's hard-earned money. So no, nothing doing. You are not allowed to issue more number of shares. If the application has come for more number of shares, you treat it like rejected or do pro rata allotment. This we will do in the later part of the classes. So it is this situation where the application money is more and subscribed capital is issued capital is less. That is called over subscription. Now opposite to this is known as under subscription. By now you must have understood what is under subscription. Under subscription means company has issued, let's say, 10,000 shares and the application money has come for 9,000 shares. This is issued and this is applied. Okay, so when the less application comes, company can issue the shares, but only when there is a condition, only when it is at least 90% of the subscribed issued capital. If it is less than the issued capital, 90% of issued capital, then company cannot issue the shares. It will have to redo the entire process. This is the requirement again by Companies Act 2013. Okay, so in case of under subscription, at least 90% of the subscription has to come from the public. So this is over subscription and under subscription, students. I hope you understood all these three concepts what I had taught you just now. Number one, we understood what are shares. These are the ownership in the company by the public. These are known as shares. Shares can be of two types, preference shares and equity shares. Then if we talk about the amount which can be collected from the public, how it can be, what amount can be collected, it can be issued at par and it can be issued at premium. Issue at par means issuing the shares at the same amount as the face value. Issue at premium means issuing more than the face value. And the extra amount which the company is collecting is known as premium. How collection will be done? The entire amount can be collected in one go, which is called collection at lump sum. Or the entire amount can be divided into various installments. This is known as collection of shares in installment. Now, when we talk about the subscription can again be of two types: oversubscription and undersubscription. Oversubscription is the situation where more number of shares are being applied by the public, but company cannot issue more number of shares. Company will have to issue same number of shares. Under subscription means when the company is issuing x number of share and receiving the application for the lesser number of share. This is a situation of under subscription. I hope till here everything is clear to you. Now we are going to the most important and favorite part of the students, which is journal entries. Yes, I know accounting students each to have some journal entries, some ledger or some numbers they want to see. With pure theory irritates you. Okay, how much ever it irritates you, you have to study, because this theory is application based theory. You have to understand. But yes, I understand that journal entries are important. You like to do the journal entries. Okay. So let's assume a situation where a company has issued 10,000 shares and it is fully subscribed. And the face value of share is, let's say, rupees 100. Rupees 50 is application money. Rupees 20 is allotment. Rupees 20 is first call. And rupees 10 is final call. So like this, company is collecting money from public in 4 installment: application, allotment, first call and final call. Here you will be very happy to see the journal entries are almost same entries what we had done in issue of debenture chapter. So I am not writing under the format, but I am assuming that you all will write under the format because it is important. So number 1 entry is bank account debit to equity share application. If it is equity share, you will write equity share. If it is preference share, you will write preference share. Equity share application account. Here you will multiply rupees 50 with the number of shares, which are 10,000. So you will apply this and 5 lakh rupees. Do make sure that you always write this, students, because when you write like this, the chances of making mistakes are pretty low. Now let us write the narration being application money received. Number 2 entry is, this is a temporary account, application account, allotment account. These all are temporary account. They are transferred to the capital. Okay, so entry is going to be equity share application account debit to equity share capital. And you'll write here being application money transferred to capital. Application money transferred to capital. So same entries we had done in the issue of debenture chapter also. Those who have not seen, please see, the link will be given to you in the description box. Now, after this, once the application money is being received, the pattern of entries will change. In application, what had happened? First, you had received money from public, because when public applies for the share, they pay you the money and then you give them, then you transfer this money to the share capital. Now onwards, from allotment onwards, first the due entry will come, means you will write application allotment money to share capital, and then public is going to pay, because first the due entry will be passed pass and then the receiving entry will pass. Only application is exception where first the money comes. Okay, so be careful. Here we are going to write equity share allotment account debit. To equity share capital. And the amount is going to be, what was the amount? 20 rupees. 20 rupees. 20 rupees per share multiplied by 10,000 shares. So this is going to be 2 lakh rupees. Being allotment money due. Then the fourth entry will be obviously receiving entry. So the entry is going to be bank account debit to equity share allotment. You received the allotment money. Being allotment money received. Next entry is going to be of equity share first call getting due. Equity share first call account debit to equity share capital. Again, due entry first. And the amount is 20 rupees per share multiplied by 10,000 is 2 lakh rupees. Next narration being first call due. Next will be receiving this first call bank account debit to equity share first call. Got it? Now here what are we going to write? Being first call received. Next entry is going to be final call. Okay, so final call will get due like the allotment money and first call money. So we are going to write equity share final call, which was 10 rupees. Final call account debit to equity share capital. Which is 10 rupees multiplied by 10,000. So it is going to be 1 lakh rupees. Okay, this money is due. Being final call due. And at the end, we will receive this final call from public. So the entry is going to be bank account debit to equity share final call. You received 1 lakh rupees from public. The narration is going to be being call money received or final call money received. Call money received. Understood? So let's revise what we've done in today's class. We will be ending the lecture after this. So first thing, we have understood that we are talking about the journal entries. The rest of the part we have already revised. So journal entries, first journal entry when you are receiving the money from applicant. So bank account debit to equity share application. Then you will close this account by transferring it to the capital. So equity share application account debit to equity share capital is second entry. Third entry is allotment money getting due. Equity share allotment account debit to equity share capital. Then next entry is receiving this allotment money, bank account debit to equity share allotment. Next entry is equity share first call account debit to equity share capital. First call getting due, then receiving the first call, bank account debit to equity share first call, then final call getting due, so equity share final call account debit to equity share capital, and finally receiving the final call, bank account debit to equity share final call. So hope students you have understood this. आपको ये सारा चैप्टर यू हैव टू रिवाइज इट अगेन एंड अगेन, ओके, बिकॉज दिस इज एन इम्पॉर्टेंट चैप्टर एंड देर आर चांसेस दैट यू हैव लर्नड इट प्रॉपरली बट यू विल फॉरगेट इट इफ यू डू नॉट डू प्रॉपर प्रैक्टिस. सो डोंट फॉरगेट टू डू द प्रॉपर प्रैक्टिस and in the regular basis, on the regular basis, if you keep on practicing and join my classes without skipping them, you will be able to master this chapter, okay. But the only thing is that investment you have to do is giving time to this chapter, and it is worth giving time to this chapter because I told you the weightage is quite high. So let's meet in the next class. Till then, bye, have a great day, and yes, if you have not subscribed to the channel till now, do subscribe and like and share the video. Bye.